Now, before we get started, it should be noted that people have been calling for the Australian property market to crash for the best part of a decade now. Remember Professor Steve Keen, who bet economist Rory Robertson in November 2008 that Australian house prices would plummet by 40%? And when that didn't happen, he had to walk up Mount Kosciuszko with a shirt reading, "I was hopelessly wrong on house prices," which he did, to his credit, and like a lot of doom and gloomers, he's subsequently disappeared into obscurity, although he pops his head up every now and then to warn of an impending crash. No doubt he'll be right one day. Now, to give Keen some credit, he did see the financial crisis coming back when most others in his profession didn't, but he couldn't have foreseen the era of record low interest rates that was to follow, which has kept borrowing costs low and house prices high here in Australia. Which brings me to this article in the Weekend Australian. Brace for the sell-off, property market at a tipping point. Now, the first thing that hit me about this article was that the chart looked out of whack. It's not houses that have taken off, it's apartments. So I went over to the source for this article, which was Roger Montgomery, and found that sure enough, the Australian had it backwards. It's the multi-story category that has shot up, although for some reason Montgomery only has data up to December 2015. So I made my own graph, because that's the kind of shit I do. So what happened here after the worst of the financial crisis had abated that led apartment construction to take off? Well, it should be remembered that Australia didn't have a recession in 2008 and 2009 like most of the rest of the world. Our unemployment rate never rose above 6%, and the RBA started to raise interest rates again, taking them up from 3% in late 2009 all the way up to 4.75% by the end of 2010. But then the sovereign debt crisis really kicked off in Europe, and the Fed and the ECB started the extend and pretend game of quantitative easing. And Australia continued to lower its interest rates all the way back down to 1.5% in September of last year. So my basic thesis is that soaring house prices and construction is mainly a story about historically low interest rate environment, which results in historically cheap borrowing costs. Consider that today you can borrow $300,000 at a 4% interest rate if you have a loan-to-value ratio of 80% or less. That means you'll end up paying back $515,000 or $215,000 in interest, $300,000 in principal. Whereas in a more normal interest rate environment where you might pay 7% on a home loan and you don't have to go back very far to get interest rates like that, you'll end up paying $718,000, of which $418,000 is interest. So $200,000 more just in interest payments alone. So in today's market, as long as you can keep your LVR under 80% to get that 4% interest rate, why not borrow $400,000 instead, since the extra interest doesn't amount to as much as $300,000 at 7%. But anyway, let's get back to the article. The much derided prediction of a sell-off in Australian property prices has finally started. Prices in some cities are starting to fall. Rental yields are becoming unsustainably low, and many property buyers are now at the point of no return. Yes, the pun is intended. Of course, you wouldn't think the property bubble has reached its finale if you looked at the headline-grabbing median prices and the ridiculous prices being paid for shoeboxes in Sydney's Paddington. Hey, what's an extra million when the additional interest is $45,000 a year? And that is the point. We know that the boom in property prices has little to do with anything other than historically low interest rates, which have made paying an extra million at auction as insignificant as an impulse purchase of a bar of chocolate at the supermarket checkout. Well, I think he's engaging in a little hyperbole there, but that's basically what I was kind of saying. I've now heard every possible explanation for surging house prices, and the only one that matters is interest rates being lower than at any time since Captain Cook first sailed across the Antarctic Circle. Surging house prices have nothing to do with a shortage of land. Hong Kong has less land and a much higher density of people per square kilometre, and that has not prevented property prices from falling. Surging dividend incomes, retiring baby boomers, and Chinese fondness for our climate and air quality are all weight of money arguments that have never prevented falling prices. And just on that foreign ownership angle, foreign buyers currently make up about 11% of new dwelling purchases and less than 8% of established dwellings. And in the boom of the last few years, they've never exceeded more than 15% of the total. So I'm not ruling foreign ownership out as a factor, but I think much too much has been made of it, and it's far more about low interest rates, low borrowing costs. Property income yields are at historic lows, and yet property buyers couldn't be more enthusiastic. Buyers who tell me that they don't mind buying on a yield of 2.5% because they'll get a capital gain need to understand that the capital gain will only come when a buyer is willing to accept an even lower yield. And yields cannot fall much further when your oversupplied property is vacant and your yield is zero, as many leveraged Brisbane apartment owners are about to discover. The end of every bubble is marked by the appearance of the greater fool principle, betting a bigger fool will come along and accept an even worse return. It's speculation, pure and simple. And of course, that's the exact same concept that plays out at the end of a stock market boom. At some point, you're just relying on the greater fool to pay higher prices. If you're buying property on an unattractive yield, it is not made more attractive by borrowing. Record levels of household debt to GDP and household debt to income and record levels of credit card debt mean that when bond interest rates rise, they've already started rising, investors will be able to least afford the additional costs thanks to having previously paid and borrowed too much. So here's a chart of household debt to GDP that Montgomery mentioned before. Now, although it looks ominous, it is an artifact of that low interest rate environment. And of course, it's true, as Montgomery points out, if interest rates rise and you're already stretched to the limit, that extra bit of interest could push you over the edge. But interest rates rising here in Australia is by no means a certainty. Whilst the Fed in the US just hiked the Fed funds rate a quarter point last week, and they're expected to raise rates at least 2 more quarter points this year, in Australia the implied yield curve in the futures market is pricing only 1 quarter point hike in the next 18 months. Now that could all change if the global economy picks up steam, of course. The Economist seems to think so, although given their track record, it could just as well be a contrary indicator. Anyway, Mark Bouris, who is the head of the second largest non-bank mortgage lender in Australia, Wizard Home Loans, had this to say last week on Jones & Co about where he sees the housing market going in Australia.
Very happy to welcome back to our show Mark Bouris. Thanks for joining us again, and we haven't seen you since last year, and I suppose the big issue I want to talk about is housing affordability. You're in the sector there, one of the leaders and inspirations in the business community. It's such a big issue, particularly in the big cities of Sydney and Melbourne. How do you see it from your perspective?
Well, the first thing I want to say is the Chinese buyers are not distorting prices. Let's just get it clear. They're a small percentage of the total number. They're not distorting prices, and I'll just park that for a second. But in terms of affordability, the big issue in this country is that we've effectively had a wage recession over the last 5 years. Wages have not grown. In fact, sometimes they've gone backwards. But house prices have grown. So there's this massive gap, the equity piece, the thing that has to be sort of jumped over by borrowers, whether they're first-home buyers or any other type of buyer. What's been amazing to me is that there's been this ability for people to find enough equity to cover that gap. But I think we're at that point now where that gap is no longer going to be covered if it keeps growing. So, and there's a reason for that. Lenders like us have all got, we all operate in a regulated environment, and the regulator is very worried about us lending too much money against the rising house prices, against a wage environment that doesn't grow. So the changes in credit policy have been happening very rapidly, and some of which is quite harsh. It's postcode driven, so in other words, concentrated risk in this postcode, so you can't lend there, or it's don't lend to investors any more than 80%, or don't only take 80% of the income that the investor gets from his rental as part of the income of the investor for assessment purposes, not the 100%. So there is a lot of panic out there at a regulator level, which is probably right, but I'm not saying it's unfounded. But what it's going to do is actually going to create a gap between the growing house prices and the amount of affordability. So I think house prices cannot continue to grow because borrowers will not be able to find the extra equity they need to continue to pay those high prices.
Right.
So obviously Mark Bouris is not a disinterested party, so take what he says with a grain of salt. But I do think he makes an interesting observation about the ability of buyers to continue to find that extra bit of equity they need in an environment of tightening credit conditions. Now let's look at rising vacancy rates. According to the article, within 5 kilometres of Brisbane CBD, 5,500 apartments were completed and available to be moved into by owners or tenants in the 9 months to September last year. During the same period, vacancy rates rose from 2.7% to 4.7%, a near doubling, 5 to 15 kilometres from the CBD. Landlords who purchased a flat that has no tenant need to deeply discount their rent or accept zero income, and that puts financial stress on the landlord even if they haven't lost their job. Most worryingly, another 13,300 new apartments will be completed within 5 kilometres of the CBD before September this year. Well, there does seem to be a little uptick in vacancy rates, but it's not exactly off the charts. Meanwhile, some financial planners have reported to me being cold called by developers and offered 7% commissions to market properties to their clients. This on top of the free holidays, free cars and free frequent flyer points being offered as incentives to property buyers. As supply increases, the discounts will become more aggressive, ensuring lower prices. Reports of some apartments being revalued 30% lower than 18 months ago isn't going to help either. Financial stress is increasing even though employment looks fine. Witness the tripling of calls to national debt helplines, with much of the increase attributed to mortgages with multiple investment properties. Citation needed. My bankers have told me all of their smartest and most successful property investors have sold up or are getting out, and they cannot lend them a cent. They won't take it. Drop a pebble in a pond and the ripples will eventually impact the entire pond and everything in it. Why should Tweed Heads and Bowral prices be 9 or 10 times incomes when thousands of similarly sized towns around the world and the same distance from capital cities can be purchased at half the multiple? It doesn't make sense, and it isn't sustainable, and neither are low interest rates. Australia's debt-fueled property boom may be handing Australia an unlucky hand. Hold on tight. Well, I tend to disregard anecdotes as they are rarely useful for determining broad trends. Now, as I said at the beginning, people have been predicting the demise of the Australian property market for a decade now, and sooner or later, one of them will be right. I feel like Montgomery's thesis relies a little too heavily on interest rate rises, which I don't think are a certainty. My biggest worry for Australia is actually a recession, since we haven't had one in more than 25 years, and to me, that's a warning sign, not a cause for celebration. So I'm big enough to admit that I just don't know what the future holds for Australian property prices. And there are other pieces to this puzzle I haven't even covered in this video. But let me know what you think in the comments below. See you next time.